Did you know that Mustang Ridge, a small city just 25 miles southeast of downtown Austin, is being touted as the next boom town in the Austin metro area? This is a significant development, considering the rapid growth Austin is experiencing, impacting even its smallest neighboring towns. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Mustang Ridge, often referred to as the last frontier of the Austin metro, has been turning heads with its potential for growth. According to Justin Sayers from the Austin Business Journal, this small city, located along the Travis-Caldwell County line, is poised to capitalize on the expansive growth of the Austin area. The city is attracting attention from developers and investors who are eager to tap into this emerging market. While Austin continues to expand, Mustang Ridge represents an opportunity for those looking to invest in a burgeoning market. The development in Mustang Ridge is a reflection of the broader trends in the Austin metro area, where growth is reaching every corner, even in places that previously seemed overlooked. It's interesting to draw parallels with regions in Ontario, such as Kitchener-Waterloo and Cambridge, where similar growth dynamics are at play. These areas are also witnessing a surge in development and investment opportunities, particularly in multifamily and tenant leasing sectors. Investors from both sides of the border are keenly observing these trends, recognizing the potential for cross-border investments. In recent developments, an office tower in West Palm Beach has been sold at a loss, fetching $45 million. This transaction has captured the attention of industry watchers, as it underscores the fluctuating dynamics within the commercial real estate sector. The office tower's sale price reflects a significant decrease from its previous valuation, highlighting the challenges that some commercial properties are facing in the current market climate. This sale is indicative of broader trends impacting office spaces, as demand continues to shift and adapt in response to evolving work environments and economic conditions. The sale of the West Palm Beach office tower is a telling example of the pressures facing office real estate markets across North America. In Kitchener-Waterloo and Cambridge, Ontario, similar dynamics are at play. These regions are experiencing a transformation in their office spaces, with a growing interest in flexible leasing options and the repurposing of traditional office environments. This shift is driven by the increasing demand for multifamily properties and tenant leasing, as businesses and investors look to adapt to new market realities. Cross-border investors are taking note of these trends, recognizing opportunities for investment and development that align with the evolving needs of businesses. The West Palm Beach transaction serves as a reminder of the importance of adaptability and strategic planning in commercial real estate investments. As the market continues to evolve, both Canadian and American investors are keenly watching for opportunities that offer potential for growth and resilience. Texas-based commercial real estate investment and development firm Headwall Investments recently announced its 18th shopping center acquisition, which has expanded the firm's portfolio to more than 600,000 square feet across the Austin, San Antonio, Dallas-Fort Worth, and Houston metropolitan areas. The property in question is Tower at Boerne, a fully leased, unanchored neighborhood shopping center in the San Antonio metro area. The attributes that attracted Headwall to invest in this property include its great visibility along high-traffic corridors, robust vehicle per day counts, seamless accessibility for customers, and a surrounding market characterized by strong household incomes. The rapidly growing Boerne community made for a long-term value investment location, positioning the tower at Boerne as a cornerstone of the firm's portfolio. George J. Womack, founder and chief executive officer of Headwall Investments, noted the remarkable evolution of the unanchored shopping center subsector of commercial real estate since he began acquiring assets in this space in 2007. Despite significant supply constraints impacting these properties in recent years, the most notable shift has been the surge in institutional interest. What was once a market dominated by smaller, individual owners has transformed into a sought-after asset class for institutional investors, drawn by robust fundamentals and the opportunity to scale in a previously overlooked corner of commercial real estate. The Northwest San Antonio commercial property is home to a dynamic mix of local and regional businesses that cater to the area's affluent and expanding population. Interestingly, none of these businesses is a large retailer or chain store that would typically anchor the property and drive traffic to it. Yet, Tower at Boerne is thriving without one. Retail investment experts have noted that a varied tenant composition, including convenience stores, local eateries, boutique shops, and service providers, has proven to be a successful retail recipe. Unanchored shopping centers have an enhanced capacity for agility and adaptability to changing consumer preferences and evolving market dynamics. This capacity makes it comparatively easier to meet new market realities more quickly than larger, anchored assets or single-tenant retail properties. Additionally, a retail property with a high diversity of smaller retail tenants can more easily adapt to changing consumer demand, which has been prevalent throughout the last few years, as it can more easily adjust its roster. In Memphis, business owners are exploring new opportunities with the Downtown Memphis Commission's initiative, Table Ready. This program aims to revitalize vacant restaurant sites by allowing restaurant owners to test locations with support in rent and utility costs for a year. The former Tamp and Tap site at 122 Gayoso Avenue is one of the first to benefit from this initiative, with Leslie and Kim Clear of K&L Food Truck and Fine Catering taking over the space. The Table Ready initiative is a strategic move by the Downtown Memphis Commission to breathe new life into unused restaurant spaces in the downtown area. By providing financial support to restaurant owners, the initiative helps mitigate the risks associated with opening in a new location, encouraging business growth and economic development in the area. This approach to revitalizing vacant spaces is reflective of broader trends seen in other regions, such as Kitchener-Waterloo and Cambridge in Ontario, where similar initiatives have been employed to stimulate local economies and attract new businesses. These Canadian cities have seen success by offering incentives and support to business owners willing to invest in underutilized commercial spaces, fostering a vibrant community atmosphere. In the United States, cities like Memphis are following suit, recognizing the potential for economic growth through strategic investments in commercial real estate. These initiatives not only benefit local entrepreneurs, but also contribute to the overall economic health of the region by attracting more visitors and residents to the area. In a significant move, DLF Group has announced plans to invest 10,000 crore rupees by the fiscal year 2027 to develop commercial properties and enhance rental income. This investment will cover both the current and next fiscal years, focusing primarily on the construction of premium office spaces and shopping malls. The expansion is set to take place in key urban hubs like Gurugram, Chennai, Delhi, and Noida, meeting the strong demand from businesses and retailers. According to a senior company official, DLF Group currently has a robust commercial asset portfolio comprising 45 million square feet, which includes 41 million square feet of office spaces and 4 million square feet of retail spaces. With an annual rental income exceeding 5,000 crore rupees, DLF is strategically positioning itself to leverage India's Grade A++ commercial real estate, known for its world-class quality and cost efficiency. Sriram Qatar, DLF Vice Chairman and Managing Director of the rental business, highlighted the company's efforts to expand its commercial footprint in Delhi National Capital Region and Chennai post-COVID-19 recovery. With capital expenditure and approvals outlay of approximately 5,000 crore rupees annually for fiscal years 2026 and 2027, DLF is set to construct some of the country's most premium commercial assets through its joint ventures with GIC and Hines, as well as through its own balance sheet. DLF's expansion plans include 2 large shopping malls in Gurugram and Noida, with additional office complexes being developed in Gurugram and Chennai. Furthermore, a data center is underway in Noida. Recently, DLF Cybercity Developers Limited, a joint venture firm where DLF holds a majority stake, reported an 11% annual growth in office rental income, reaching 3,874 crore rupees last financial year. The rental income from retail real estate properties grew by 6% to 880 crore rupees in the last fiscal year. On the back of strong financial and operational performance, DLF Cybercity Developers Limited received a credit rating upgrade from CRISIL to AAA with a stable outlook, marking it as one of the few non-listed entities in India to obtain such a rating. ICRA also improved its rating to AA+ with a positive outlook. As India's largest real estate firm by market capitalization, DLF has developed more than 352 million square feet of area across over 185 real estate projects since its inception. With a development potential of 280 million square feet across residential and commercial segments, DLF is well positioned to capitalize on the growing demand for high-quality commercial spaces. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.